Roth IRAs are awesome. Not enough people are taking full advantage of making contributions to a Roth retirement account. And it's not just Roth IRAs where I think people are missing the mark. Roth 401ks, 403bs, Roth thrift savings plans. A lot of you have access to retirement accounts through your employer and or you have a Roth IRA as well. And together, they can function in such a beautiful way as a tax diversification piece. Now, that's just some big fancy word, but let me be clear on what I'm saying here. When you put money into a Roth, that money grows tax free. You understand that. But what may be more difficult for you to understand is how income is generated in retirement. Now, when I say income, that may mean cash flow to you. And I understand that, but I'm going to try and dissect why income and cash flow are actually two separate and different things completely. See, just so you know, when you take money out of a bank account, that's not a taxable event. Newsflash, you probably already knew that. But when you take money out of a bank account, at some point in the future, it was already taxed. Whether that was when you worked for the money and you paid the taxes on it and now it's sitting, or maybe it was gifted to you or part of an inheritance, whatever the case may be, when you pull money out of a bank account, there's not a taxable event. Now, maybe a few of you are saying to yourself, wait a minute, I get a few pennies in interest on my bank account. All right, it's not even worth talking about. But just know that that money comes out after tax. When you take money out of a 401k or IRA, that is money that nobody has yet to pay income tax on, not you or your employer if they're making a profit sharing or a matching contribution to your retirement account. They didn't pay the income tax on that contribution either. And so when you take the money out in retirement, it's generating a taxable income event and you're getting the cash flow. Notice the difference there between taking money out of a bank account where you get the cash flow, but it's not an income or specifically a taxable income generating event. When you take money out of a Roth IRA, the money that comes out is tax free. In other words, it does not create an income event. You still get the cash flow coming to you, and you can certainly live on that cash flow in retirement, do whatever you want with it, but it's not an income tax generating event. How about with a health savings account? When you take money out of an HSA, much like a Roth IRA, cash flow is coming into your life, assuming it's used to pay for medical expenses, whether they're current year medical expenses or maybe you've taken your HSA game to the next level and you're actually using for prior year medical reimbursement, which is awesome because you got to enjoy the tax-free growth, the compound interest, all tax-free on that money while it was in the account. Again, cash flow is coming into your life, but not a taxable income generating event. When you get money from a pension, that is a taxable event. So now we have the cash flow and the income. Those are synced up just like a 401k or IRA distribution. And in many cases, it's similar for Social Security. When you receive Social Security, you're getting that cash flow coming into your life. And in many cases, for a number of you, at least a part of that is taxable as income. Maybe up to 50% of what you're receiving is included as taxable income. In some cases, up to 85% is taxable as income. And by the way, they didn't change that with the big, beautiful bill that was passed. All they did is now give for a limited time, just so we're clear, just for a limited time, it's not forever, but for those individuals who are 65 when the law is in effect, they can get an extra $6,000 deduction. Again, it has nothing to do with whether or not you're receiving Social Security. It has to do with your age. And as long as it's in the window of time for the triple B, the big beautiful bill, then you get that extra $6,000 deduction, which for a good chunk of retirees, yeah, it's going to wipe away any tax that they would have to pay on their Social Security. But for a number of you, it's not going to wipe it out completely. So just be aware of the triple B's impact. And I know they talked a long time about getting rid of tax on Social Security. That's not quite how it works out in the end. But back to the Roth. Remember, when you take money out of a Roth, not an income generating event from a tax perspective. The nice part about this is it can help to keep the amount of your Social Security that's subject to tax low. Social Security looks at provisional income. It's a special calculation And they look at specific numbers to determine how much of your Social Security benefit, by the way, it's called primary insurance amount, PIA, but just know we're going to say Social Security benefit to mean the monthly cash flow or the check that you're getting when you're on Social Security. They look at the provisional income to determine how much of your benefit is subject to tax, how much to include as income. Similar but different to Medicare. With Medicare, they look at your adjusted gross income, or modified adjusted gross income is another one you may be familiar with. They're very similar in most situations. It looks at a different calculation to determine how much you're on the hook for your Medicare premiums. And remember, it's not Medicare Part A. You've been paying for that your whole life while you've been working, but Medicare Part B or Medicare Part D if you also have a prescription drug coverage, if you have a policy to cover that. And so, in essence, the more income you make, not cash flow, the more income you make, the more you pay for health insurance under Medicare. And it's similar if you're on health insurance before the age of 65 and you're on an Obamacare or Marketplace or Affordable Care Act plan. They all essentially mean the same thing. So health insurance before Medicare. And by the way, it looks at current year's income there, whereas Medicare looks back 2 years. There's a 2-year delay. My point in saying all this is that I've had a number of conversations recently with individuals, all of whom are in their 60s. Go figure, most of the folks that I work with are kind of in their late 50s, 60s, or maybe early 70s. And when they take money out to live on in retirement, it's not all included as income. And alternatively, it doesn't have as many impacts on Social Security and Medicare or health insurance and other things. My point in saying all this is they all wish they had more money in Roth. And oftentimes I'll get asked, Rizek, how long has this Roth been around, or the ability to do Roth conversions? And it's been around for a number of years now. In fact, knocking on a few decades. But they just didn't realize how impactful having Roth assets was, because Roth assets produce Roth income. And Roth income is really not income at all for tax purposes. It's not included. It's a tax-free distribution, which, as I've just pointed out, has numerous implications: Social Security, health insurance, etc. The more money you can get into a Roth account, and the sooner you can get it in, the better, because now that money can grow unburdened by taxes for a lot longer. And when compound interest gets layered on with tax-free growth, it's a beautiful, beautiful thing. Now, for many of you, the majority of your retirement savings is, in fact, inside of pre-tax 401ks, IRAs, and other retirement accounts that may be sponsored by your employer. It's not too late. The boat has not sailed out of the harbor quite yet, even if you're approaching retirement or just recently retired, because right now you can convert as much as you want to Roth. Now, let me be crystal clear. The goal is not to convert all your money to Roth. We don't want you to pass away having thousands, millions of dollars inside of a Roth account, unless, of course, you're wanting to give money to your kids or grandkids and they're in a significantly higher tax situation than you are, which is very rarely the case, but maybe once in a while. Rather, the goal is to keep your income tax liability low throughout your lifetime. A lot of people delay or, in fact, avoid Roth conversions altogether because of some of the external impacts it has, primarily regarding health insurance premiums. See, when you do a Roth conversion, you are now moving money from pre-tax retirement accounts, like an IRA or 401k, to a Roth equivalent. If you're doing it while you're still working and your employer offers it within the 401k plan, then you may in fact be able to just move the money from the 401k to the Roth 401k, all within your employer-sponsored retirement plan. But for many of you, you're recently retired or about to, and we just move it to an IRA. And then from the IRA, we move specific amounts to Roth. Now, like I said before, the goal is not to convert everything, and certainly not all in 1 year, because if in fact you were to convert all your retirement savings to a Roth IRA in a single year, boy, you'd be in for a rude awakening come tax time. Remember, every dollar that you convert typically generates the same amount of ordinary income, which is taxable. And again, the cash flow isn't coming into you. It's not like you're spending that money. You actually have no change from a cash flow perspective, ignoring the tax cost, of course. You're just moving it from one retirement account, an IRA in this example, to another retirement account, a Roth IRA. However, now the money can grow tax free, which is hugely beneficial, especially if you don't need the money for a while longer. Once in a while I'll get asked about the 5-year rule. There's a couple of different 5-year rules that apply to Roth IRAs, in fact. But the goal for most of you should not be how soon can I get access to my Roth money? And if I convert it today, will I get penalized if I pull the money out within 5 years? There's ways to navigate and plan ahead for that. So that doesn't have to be a concern. But I think you're asking the wrong question if that is your question, because if you're putting money into a Roth today, the goal, 9 times out of 10, is to let that money grow for as long as possible until later years so that you can enjoy the tax-free compounding growth. It's your investments generating income, generating interest and dividends that then is getting reinvested and growing. That's really where the Roth shines, and having the money growing for a long period of time. In fact, when I'm modeling out, retirement plan and tax plan projections for clients, the longer they live, the more valuable the Roth conversion. Or in other words, the longer you can leave the money in the Roth, the more exciting and the more compelling it is from a tax perspective to do the Roth conversion today. But shoot, if you're going to do a Roth conversion and you think you're going to need the money in 3 or 4 years, it probably doesn't make sense for you to even be considering a Roth conversion in the first place. Okay, back to the scenario where you have a big chunk of your retirement savings. Maybe all of it is in pre-tax retirement accounts. We now need to think about all the external costs associated with you doing a Roth conversion. For example, if you convert $50,000 to a Roth IRA from a traditional IRA, you're now going to generate an additional $50,000 of income. Again, no cash flow is coming into your life. You're just moving it from, in essence, one pocket to another, from one account to a different account. When you do that conversion, there's tax consequences at the federal, and depending on where you live, could be at the state level as well. In addition to the taxes, you could also face higher health insurance premiums if you're no longer covered by an employer-sponsored health insurance plan at work. And for those of you who are self-employed or who are already retired, it goes without saying, you understand that your income, primarily your taxable income with maybe a few adjustments, directly impacts the amount you pay for health insurance coverage today, whether on Medicare or pre-Medicare. So with that in mind, sometimes it makes sense to actually begin doing Roth conversions while you're still working. Now, for a few of you, you're saying to yourself, wait a minute, Rizek, did I hear you correctly? And the answer is yes. Even if you're still working and making really, really good money, shoot, maybe you're in the highest tax position you've ever been in your whole life, it can still make sense in some situations to do Roth conversions while you're still working, because while there still be a tax impact, there won't be as significant a health insurance impact, right? If you're making $100,000 of taxable income, or you're making $300,000 or $500,000, whatever it is, as long as you're covered by an employer-sponsored health insurance plan at work, it's not like your premiums are going to go up. You understand that. But that would not be the case if you waited until you were retired, no longer covered, and now we have to start to think about premiums. But let me just be straight up with you, especially once you're 65, and for those of you who are already on Medicare, sometimes I hear again and again, in fact, it's not sometimes, it's frequently, where people will avoid picking up a dollar to instead grab a dime. They step over the dollar to get the dime. Here's what I mean by that. They are so laser focused on trying to keep their health insurance premiums low under Medicare that they avoid the enormous income tax savings that exist by doing a Roth conversion. They hate to see their health insurance premiums go up a few $100s a month, temporarily, by the way. It readjusts every year. But they hate to see it go up a few $100s a month, and they would prefer a few $100s a month in health insurance premiums savings to tens, if not hundreds of thousands of dollars in tax savings over the course of their lifetime in income tax savings. That's because they don't want to do a Roth conversion. And I hear you. Nobody, I'll be the first to confess, nobody wants to pay more in health insurance premiums than they have to. Nobody really likes paying insurance, whatever, let alone health insurance. But you got to have it. We understand that. And what I'm suggesting is that you factor in the tax costs of doing the Roth conversion plus any external costs. Medicare would be one of them in this example. You look at what that cost is today relative to what the cost will be of not doing a Roth conversion in the future. See, when you don't do a Roth conversion, now you have money continuing to go pre-tax in your retirement accounts. And at some point in the future, required minimum distributions will kick on. Maybe that's when you're 73. For some of you, it will be 75. When you turn that age, now the government says, all right, how much money is in that retirement account? How old are you? Now that we know both those numbers, we're going to force you to take out a specific dollar amount every year so that the IRS can collect taxes on it, right? Remember, the money that you put into this retirement account or that your employer put in has not yet been taxed. And they've essentially said, hey, it's been long enough. We want to start getting a slice of the action. So they force this money out. As your account gets larger over time, well, now you're going to have larger required minimum distributions. And for many of you, you're going to keep investing. It's not like it's going to sit around and cash in your IRA. You want to keep pace with inflation. You want to see that growth. I totally get it. So recognize that required minimum distributions continue to grow for many of you the older you get because investments are growing and because of your age. So as you get older, the tables that the IRS uses to determine how much in required minimum distributions you're on the hook for, they increase. A greater percentage is being distributed the older you get. And if your investments are growing, it's a greater percentage on a greater dollar amount. And by the way, they look at your IRA balance at the end of every year. So your December 31st ending account balance, and then divide it by a factor based on your age. For a number of the families I work with, they are now in a required minimum distribution age phase. They're in their late 70s or 80s, and they're being forced to take out a significant amount of income, which is taxable, regardless if they need the cash flow or not. In fact, in many instances, they don't need the money to live on. This is just money that's being forced out, and they're now on the hook to pay taxes on that. Again, both at the federal and in many places at the state level as well. And for some of them, those required minimum distributions are actually causing them to pay significantly more in Medicare premiums because now their hands are tied. They don't have the choice or the flexibility to control their income tax situation as much as they did prior to reaching their required minimum distribution age, RMD. Because before that, you have the choice. And yeah, certainly goes without saying that the timing of when you take Social Security definitely impacts how much you do in a Roth conversion and when you do it. And longevity, if you're married or single, that can have a significant impact over whether or not it makes sense to do a Roth conversion in the first place. So let me just emphatically state this again. The goal is not to reduce your taxes this year alone. Rather, it's to reduce the taxes and any other associated costs, like healthcare, as we've pointed out multiple times, over the course of your lifetime. But your whole life, you've probably been trained just to reduce your taxes this year. I mean, otherwise, you wouldn't have so much money saved in pre-tax 401ks and IRAs. The fact of the matter is that if you maybe did a little bit more long-term tax and retirement planning, you'd be more incentivized today to have more Roth money going in, maybe making more Roth contributions. But it's not too late. For many of the people I work with, 80 to 90%, it's not uncommon, of all their retirement savings will be taxable in retirement. And if you're in a lower tax situation in retirement than you are when you're working, that's wonderful. But for a number of you who have saved and invested wisely throughout your life, you've had a disciplined long-term investment approach, and you've been rewarded for that, you may find that when you start to project out using reasonable rates of return, but when you start to project out what your required minimum distributions will be in retirement, you start to see that the writing is very quickly on the wall. And that writing gets bigger and bigger and more compelling when you recognize all the other costs outside of just the tax costs that are associated with now this higher income event that's going to be there for the rest of your life. Now, for one or two of you who have already reached required minimum distribution age, maybe you started having RMDs kick on when you were 70 and a half. They changed the law a few years ago, but 70 and a half or maybe 73 or older, it's not too late. While you cannot convert a current year's required minimum distribution, you can convert everything else. So once you hit RMD age, you still have to take the money out. But once you satisfy that year's distribution, the other money that's still in the IRA, you can, if you want, convert it. For some of you, that might make sense. But for others of you, the ship may have sailed at that point because such large a distribution is now coming out that you really don't have a lot of runway to work with. Think of it as if you're flying a plane. Now, I don't have my pilot's license, but when I dream at night, I think it'd be awesome to have a pilot's license and fly a plane. The longer the runway you have, the more cushion you have to take off. It doesn't take a pilot to figure that out. When we think about tax planning, it's very similar. If you have a short runway, we don't have a lot of wiggle room. Maybe it doesn't make sense to do a lot of a Roth conversion. But when we look at your tax bracket and we see that you're right here, the plane is this far along the runway, well, now we've got a lot to work with. And it might make sense to actually fill up, that's the term we use, fill up your current tax bracket or bucket, if you want to call it that. In other words, we've got a lot of runway we can work with here. Let's do some Roth conversion, of course, after we figure out what the tax cost will be and any other external costs you may face in retirement. Let's determine what that is, and then let's build a plan. And let's test it in a variety of scenarios. Just like a pilot might, impact how much runway they need based on weather conditions, if it's wet or if there's snow on the runway or something like that versus dry. You may want to see what would happen if the stock market was on a tear for the next few years and actually was significantly better than you imagined. Or what if it's worse? Or what if tax rates go up or tax rates go down? Or what if, just imagine, what if for a moment Medicare and Social Security had some big changes that were coming down the road? Which, by the way, it's not a far cry to recognize that at some point between now and 2033, the next, we'll call it 8 years, there will be undoubtedly some significant changes to how Social Security and Medicare works, operates, the benefits received, the costs that are going to be needed to pay for this. Like, that's going to be some significant impacts. And the more that you can do right now to plan and prepare for those storms or the sunshine that may come down the road, the better off you'll be. I mean, how many times have you heard about investment diversification? It's just all over the place. You get it. I get it. We don't want to have all your eggs in one basket. But tax diversification, that's something that very, very few people talk about. It's important that you have money and investments and assets plus income in different sources so that if something changes in the future, you can be flexible. You can kind of roll with the punches. If something happens to Medicare and now all of a sudden it's costing you significantly more for the same level of coverage because now they've changed the calculation or they've changed the brackets or whatever, it might make sense to have some money in a Roth account that you can pull from that's not going to impact your Medicare premiums, for an example. So diversifying taxable income makes a ton of sense. And while doing Roth conversions today may cost you more right now than if you did nothing, in many instances, it will save you enormously long term. My name is Rizek. I'm a financial advisor, happens to be a CPA as well. I make personal finance and retirement planning simple and easy to understand. If you enjoyed this, you're going to love my book, Finance on the Fly: Simple Strategies to Build Lasting Wealth. You can pick it up on Amazon for the cost of a burrito with guac, and I think it'll pay significantly better dividends.